Welcome to another exciting episode of Financial Insights in Minutes. Is the economy on the brink of disaster? We'll break down the latest warnings about a recession and what the housing market signals mean for your investments.
Expert predictions on a stock market crash will have you on the edge of your seat, and we'll uncover what's next for Bitcoin.
Don't miss this critical financial news review. Your wallet could depend on it. What videos will we be covering in today's episode?
Today we're going to provide summaries of the following videos.
First up, George Gammon warns about a looming U.S. recession and bank risks. Next, Gareth Soloway analyzes bullish Bitcoin signals amidst bearish stock trends. Following that, Game of Trades explores the possibility of a massive stock correction. Then, Lance Roberts dives into whether the recent stock sell-off is a head-fake rally. Brian Kim debates the legitimacy of passive income. Is it a pipe dream? Jack Farley gives insights into whether it's time to be bullish on the market. Joseph Wang breaks down recent market volatility and strong U.S. economic performance. Lastly, Chris Ciovacco uncovers whether the market outlook is concerning or reassuring. Welcome to Kitco News on YouTube. Today, we're digging into whether banks know a crash is coming and what the most powerful economic indicators are signaling. It's going to be a fascinating discussion.
Absolutely. George Gammon, the renowned investor and host of the Rebel Capitalist show, breaks down some pretty ominous signs suggesting a looming recession. Let's strap in, everyone.
So what's the big takeaway from George Gammon's insights?
Gammon believes the U.S. economy is on the brink of a severe recession. Despite positive GDP and controlled inflation, indicators like the inverted yield curve and banks' tight lending behavior signal trouble ahead.
Can you break down those key economic indicators for us?
Sure. Gammon points to the inverted yield curve, which has predicted every recession since the 1950s, and banks are avoiding lending because of high perceived risks. They'd rather park their money in treasury bonds.
What's the scoop on this banking crisis talk?
Well, the recent collapses of Signature Bank and First Republic are just the tip of the iceberg. Unrealized bank losses have ballooned from $75 billion during the Great Financial Crisis to $700 billion today. Yikes.
And how about the Federal Reserve's moves?
Yes. The Federal Reserve's Bank Term Funding Program provided a temporary fix, but it didn't address core issues. Gammon predicts the Fed will soon cut interest rates aggressively to combat the crisis.
All right, let's peek into George's crystal ball. What's he predicting?
He forecasts a severe recession akin to the early 1980s or the 2008 crisis. The interconnected banking system poses significant systemic risks.
And those interest rate cuts?
He's expecting substantial cuts, perhaps up to 5%, starting as early as July. The market might see rapid successional cuts to mitigate the economic slowdown.
What about economic metrics?
Gammon bases his predictions on declining M2 money supply and rising delinquency rates in auto and credit card loans. It's a storm brewing.
So, wrapping it all up, what's the big picture?
Gammon concludes, we're heading for a hard landing due to systemic banking risks and the inverted yield curve. He suggests strategic caution to safeguard financial assets while navigating these turbulent times.
Welcome back to the David Lin YouTube channel. Today's focus: what's causing bit waves in crypto and tremors in tech stocks?
Oh, it's a riveting session with Gareth Soloway, chief market strategist at verifiedinvesting.com. He's dropping truth bombs on Bitcoin's future and the stock market's shaky ground. Buckle up.
So what's the juicy takeaway from Gareth Soloway's analysis?
Gareth's main thesis is a mixed bag. He's bullish on Bitcoin after recent consolidations, bearish on overvalued tech stocks, and believes the stock market bump is a temporary hiccup, not a trend. He sees more downturns ahead for various assets due to economic slowdowns and overvaluation.
Let's break that down, starting with Bitcoin. What's the outlook?
Bitcoin's recent consolidation is actually bullish. Gareth expects another breakout in the next couple of months. Bitcoin's shaping up as a hedge against market volatility, akin to digital gold.
Now to the tech stocks and NASDAQ. What's the tea there?
Tech's overvalued with high price-to-earnings ratios. Gareth's technical analysis shows bearish signs like reversal engulfing candles on the NASDAQ, suggesting a massive sell-off similar to 2021's downturn.
How about the general market trends and their implications?
The recent tech sell-off is the biggest since 2022. Despite a minor rebound, Gareth doesn't think it will last. Economic indicators like PMI and jobless claims show a slowing economy, adding more pressure to valuations.
All right, predictions time. What's Gareth crystal balling?
He sees a market decline when the Fed starts cutting rates, predicting a 35% drop in the Nasdaq. Also, Bitcoin likely surges after current consolidations. He's also watching rising delinquency rates on consumer credit as an underlying market risk.
Wrapping this up, what's the big picture?
Gareth advocates for strategic caution. Be wary of overvalued tech stocks, watch Bitcoin's potential breakout, and prepare for broader market declines due to economic fundamentals. His advice? Let data, not emotion, guide your trading decisions.
Welcome to Game of Trades. Today's episode is all about a potential massive rug pull in the stock market. Ready for some nail-biting analysis?
You bet. We'll look at the possibility of a major correction amid some very bullish trends. Grab your trading hats, folks.
What's the main takeaway from today's video? Are we looking at a stock market cliff diving session?
The core thesis is intriguing. While the market is bullish, there's a possibility of a significant correction. Investor sentiment has shifted dramatically, which could mean a substantial downturn is on the horizon.
Okay, let's break it down. What about investor sentiment?
On July 17th, 53% of investors were bullish, up from 30% in April. This high sentiment usually leads to market peaks. Since that date, the S&P 500 has dropped over 3%. Buy low, sell high, right?
Interesting. Now, what historical trends are we seeing?
Even in strong bull markets, we typically see multiple 10% corrections. Between 1990 and 1999, there were 6, and between 2009 and 2020, there were 7. So a correction isn't out of the question.
Gotcha. But what's the current vibe with the S&P 500?
The S&P 500 broke below a key trend line on July 18th, signaling potential short-term volatility. However, the overall structure is still bullish, with all important moving averages pointing upwards.
Let's talk volatility and the VIX.
The VIX, the stock market's fear gauge. It spiked recently, which aligns with the S&P 500's drop. But the VIX has been trending lower, suggesting this spike might be short-lived.
And what are the smarty pants investors up to?
The OEX open interest ratio, our smart money sentiment indicator, is historically low. This means informed investors are currently bullish. This is a great sign for the market's health.
So what's in the crystal ball? Any predictions?
First, expect short-term volatility, but the overall uptrend seems strong. However, if the S&P 500 breaks significantly below its current price channel, we might have a bigger problem.
Wrapping it up, what's the final word?
Stay cautiously optimistic. The market is in a strong uptrend, supported by smart money sentiment. But keep an eye on those key indicators and be ready to adapt if things start shifting. Trade smart.
Hey there, welcome back to Thoughtful Money. I'm thrilled to present another weekly market update.
Today, we have some fascinating insights to share from a recent interview featuring Lance Roberts and Adam Taggart. We'll dive into what's driving the recent market movements, discuss the current economic landscape, and share some predictions and conclusions.
So what's the big idea here? What's the main point they discussed?
The central thesis is about whether the recent stock sell-off signifies the end of a correction or if it's just a head-fake rally. Lance Roberts provides a detailed analysis of market signals, potential investor reactions, and economic impacts.
Let's break down those key points. First up, market corrections. What's Lance saying here?
Lance mentions that the current market correction is expected and not necessarily a reason to panic. The market had been overbought, and what we are seeing is a natural cooling-off period. Interestingly, despite the sell-off, volatility remains relatively subdued, indicating the market is not in panic mode.
Got it. Next, Lance discussed some economic indicators. What should we be paying attention to?
He delves into the major economic indicators like GDP growth, inflation, and unemployment rates. These indicators are pointing towards a moderately healthy economy. High levels of government spending and inventory buildups have contributed to the robust GDP numbers.
And market sentiment and behavior. What's the vibe out there?
It's fascinating. The discussion highlights the psychological aspects of investing. like how people react to market drops and corrections. Lance emphasizes the importance of looking at the bigger picture and not getting swayed by day-to-day market volatility.
All right, let's get the crystal ball out. What's Lance predicting?
Firstly, Lance predicts that the market could continue to show some upward movement due to being oversold, but he cautions that this does not mean we are out of the corrective phase.
And what about those important Fed interest rate decisions?
Despite strong economic indicators, Lance thinks the Fed might start cutting interest rates as early as September. The reason? To avoid a potential recession, considering the high levels of debt in the economy.
So what's the final word here?
Lance urges investors not to panic due to the current correction phase. It's a good time to rebalance portfolios and prepare for potential buying opportunities in the near future. The key takeaway is to stay informed and ready to act based on precise market signals.
Welcome to ClearValue Tax's YouTube channel. Today's sizzling debate, passive income. Is it the golden ticket to financial freedom or just a pipe dream? We'll break it all down with insights from our very own Brian Kim.
Absolutely. Brian dives into the nitty-gritty, helping us separate fact from fiction when it comes to living off passive income. Stick around, it's going to be enlightening and maybe a little surprising.
All right, let's get to the heart of the matter. What's Brian's main argument in this video?
The crux of it is that passive income is better viewed as a supplementary source of income rather than a primary one. Brian argues that, while valuable, passive income is not the silver bullet many think it is.
Interesting. So what are the key points that Brian emphasizes?
First, he divides people into two groups: those who think passive income is a scam needing lots of cash, and those who see it as a financial freedom key. He firmly believes it should be viewed as extra money rather than a primary source.
Got it. And what practical examples does he give?
He does some quick math. If you have $1 million earning 5% interest, that's $50,000 a year. While significant, it's hardly enough to quit your job. He also mentions investing in high-yield savings accounts, CDs, and dividend stocks as potential avenues.
Okay, but what about rental properties? Aren't they a popular passive income source?
Brian has a hot take there. He says rental properties aren't truly passive because they still require effort and stress. Instead, he recommends REITs, which let you invest in real estate minus the headaches.
Sounds practical. Any big no-nos he mentions?
Oh, yes, he advises strongly against investing in someone else's small business. He calls it a quick way to lose money, so due diligence is vital if you go this route.
Great tips. So what's Brian's personal strategy for passive income?
He budgets properly, invests surplus money defensively, and uses index funds, ETFs, and even gold and silver for stability. Plus, he stresses paying off high-interest debt and utilizing retirement accounts first.
Time to gaze into the crystal ball. What does Brian predict?
If interest rates on savings accounts drop below 3%, Brian plans to pull his money from the bank and seek better opportunities, always staying one step ahead.
Wrapping it up, what's the big takeaway here?
Brian emphasizes that passive income is significant but should be seen realistically as supplemental and safety net income. Focus on clearing high-interest debt and maximizing retirement accounts first. Wise words for cautious navigating.
Welcome to Blockworks Macro. Today, we're diving into whether it's finally time to be bullish. We're dissecting the latest on the margin, Roundup edition, with insights from the ever-astute Jack Farley. Ready for some spicy market talk?
Absolutely. Jack gives us a deep dive into the economic indicators, market dynamics, and how fiscal and monetary policies might be shaping a bullish narrative. So let's get to it.
So, what's Jack's main argument here? Are we finally seeing the light at the end of the bearish tunnel?
Jack's thesis is intriguing. He argues that current market conditions, backed by stronger than expected economic indicators and supportive fiscal and monetary policies, are setting the stage for a bullish trend. However, he cautions that investors should remain nimble due to ongoing short-term volatility.
All right, let's break it down. Starting with the economic indicators, what's the scoop there?
GDP for Q2 came in hotter than expected at 2.8%, driven by a rebound in personal consumption expenditures in both durable and non-durable goods. This data contradicts fears of an imminent recession.
Interesting. And what about fiscal and monetary policies? What role are they playing?
The Federal Reserve is expected to cut rates, with markets pricing in nearly 3 cuts for the year. On the fiscal side, the U.S. government's heavy spending, despite running deficits, is pushing nominal GDP growth higher.
Seems like there's a lot of action on the market dynamics front. What's cooking there?
We're seeing a significant shift from large-cap tech to small-cap stocks due to changing financial conditions. Additionally, systematic flows and VR shocks have caused some short-term volatility, but these moves are opening up opportunities for astute investors.
All right, time to dust off the crystal ball. What does Jack predict?
First, Jack sees a continued market rebound thanks to rate cuts and fiscal stimulus, particularly benefiting small and mid-cap stocks. Second, he forecasts a sector rotation from large-cap tech to smaller, undervalued sectors. And in the crypto world, Bitcoin and other cryptocurrencies may see short-term spikes but could face sharp corrections afterward.
Wrapping it up, what's Jack's big takeaway?
Jack concludes on a cautiously optimistic note. Economic conditions are improving, driven by supportive fiscal and monetary policies. However, it's crucial for investors to stay informed, be ready to pivot, and approach the market with strategic caution.
Welcome back to Joseph Wang's channel. Today we're diving into the market's weekly update for July 27th, 2024. Ready to break down the wild ride the markets took this past week?
Absolutely. Joseph's got some keen insights on recent volatility, impressive economic data, and some eyebrow-raising moves by the U.S. Treasury. Buckle up, it's going to be a bumpy but fascinating ride.
So what's the big takeaway from Joseph's update this week?
The main thesis is all about market turbulence, robust U.S. economic performance, and a deep dive into a paper analyzing how the U.S. Treasury's actions are easing financial conditions.
Let's break it down. First up, market volatility. What's been happening there?
It's been a roller coaster. The Japanese yen saw huge swings due to serious deleveraging. The yen appreciated from 161 to as low as 152 on the USD-JPY cross.
Wow, that's significant. And how's the U.S. economy looking?
Pretty solid. The GDP for Q2 came in at 2.8% annually, a big upgrade from Q1. Plus, the PCE inflation rate is moderating, landing at 2.6% year over year. Inflation's headed in the right direction towards the Fed's 2% target.
Good news stateside. What's happening globally, though?
Global scene's all about rate cuts. The Bank of Canada, following in the Swiss National Bank and ECB's footsteps, cut rates again. Slower growth and declining inflation are the main drivers.
Fascinating global trends. And what about the U.S. Treasury's impact on markets?
Well, a paper by Stephen Moran and Nouriel Roubini argues the Treasury's been easing financial conditions by increasing the issuance of short-term Treasury bills. This strategy could have lowered the 10-year yield by about 25 basis points. Think of it like an indirect form of quantitative easing.
Time to peer into the crystal ball. What does Joseph foresee?
Joseph expects the Fed might guide us towards a September rate cut, with potentially 3 cuts by year-end. As for Canada, more rate cuts could devalue the Canadian dollar further against the U.S. dollar.
And the future for the Treasury's strategies?
Interesting times ahead. If the Treasury reverses its current strategy, we could see long-dated yields spike, tightening financial conditions. Definitely something to watch.
All right, bring it all home for us. What are the key takeaways?
Despite market volatility, the U.S. economy is strong with solid growth and easing inflation. Global rate cuts and the U.S. Treasury's clever issuance strategies are crucial themes. Keep an eye on Fed moves and global indicators.
Welcome to CiovaccoCapital on YouTube. Today's burning question: is the big picture reassuring or concerning for stocks? Chris Ciovacco is here to shed some light.
That's right. Chris dives into volatility trends and outperformance of small caps, all to help us figure out where the market is heading. Let's break it down.
So what's Chris's main argument? Is the market's big picture a beacon of hope or a sign of trouble?
The core thesis is to assess whether the current market trends are reassuring or concerning for stock investors. Chris starts with a deep dive into volatility and transitions into small cap performances to get a sense of the overall trend.
All right, let's get into the nitty-gritty. What does Chris say about volatility and primary trends?
Volatility, Chris notes, is as inevitable as your morning coffee. He reviews historical trends from 1950 to 2000, showing that even during long-term upward trends, volatility is just part of the journey. Current data supports that we're still in a secular uptrend.
And what's the latest scoop on small caps?
Small caps, stars of the show from 2012 to 2015, are making a comeback. Chris sees promising signs, but emphasizes not to mistake short-term rotations for major shifts. Patience is key.
Ah, patience, the virtue we all wish the market had more of. But what about the Federal Reserve's role here?
Great question. Chris highlights a potential interest rate cut by the Fed in September 2024 as a boon for the market. A policy shift like this could ease market jitters and push stocks higher.
All right, crystal ball time. What does Chris foresee for the market direction?
Higher highs, baby? Chris predicts that despite short-term volatility, the market is on track for gains. But keep your seatbelts fastened. Minor corrections are just part of the ride.
And how about those small caps?
Small caps could outshine their larger counterparts if current trends keep up. However, we need to keep an eye on them to confirm this shift. No counting chickens before they hatch, right?
So to sum it all up, what's the biggest takeaway here?
Patience and discipline are your best pals right now. Chris advises to stick with the secular trend and not get spooked by normal volatility. Take it day by day and keep an open mind while navigating these market waters.
In this video, George Gammon discusses systemic banking risks leading to a severe recession.
Gareth Soloway predicts a bullish Bitcoin but a bearish Nasdaq.
Game of Trades explores cautious optimism amidst short-term volatility. Lance Roberts talks about a potential head-fake rally and the Fed's planned rate cuts.
Brian Kim advises passive income as a supplemental strategy.
Jack Farley highlights economic growth and potential bullish trends.
Joseph Wang emphasizes U.S. economic resilience amidst market volatility.
Chris Ciovacco reassures us about the long-term uptrend despite short-term volatility. While some experts disagree on specific outcomes, they all stress the importance of staying informed and strategic. Stay tuned for more invaluable insights on Financial Insights in Minutes. Thanks for watching Financial Insights in Minutes for July 27th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.